Thank you everyone for joining our webinar and discussing how we see the economy panning out post-COVID and in the next few months, and the potential impact on real estate, which is not disconnected from macroeconomics and the rest of the economy, especially in a scenario like the current one. We have an amazing panel of speakers today. We have with us Jason. And Jason is a partner and a senior financial planner at Woodgate Financial. He's an award-winning financial planner who has lived and breathed topics related to financial planning for over 20 years. The way I met Jason was I was a follower of his articles for a long time before we connected. And he has been a recognized writer, commentator, speaker, podcaster, you name it. So he is the guru of financial practice and fintech. He has 2 degrees, 9 professional designations, and tons of awards that he has won in the industry, in addition to articles and podcasts. And if you're not already reading his articles and podcasts, I highly recommend. They are very well produced, and there's a lot of effort that goes into him putting his perspective. We also have with us Harrison. Harrison is the Director of Sales at the esteemed Milbourne Group. He is an astute real estate advisor and investor. He has over 16 years of experience in the industry and knows everything from sales to project management, pre-construction, post-construction. He is the guru in the real estate space. So we are lucky to have 2 big experts in their respective areas join us and talk about how COVID might impact investments. Harrison also has a degree in community design from Dalhousie University. And of course, he's a RICO registered sales professional. Even thank you and welcome to our BuyProperly webinar today, both of you. For those of you who don't know me, I'm Khushbu Jha. I'm the founder of BuyProperly. We are an online platform of fractional investing in real estate. In simple terms, we allow people to buy a fraction of a house. So you could buy 5 to 10% of a house and earn 10% of the rental income and proportionate share of exit price when you sell. Okay. So with that, I would like to kick it off, and let's start with the core question that we are going to discuss today. So where do you, maybe Jason, I'll start with you. Where do you see the economy heading for the rest of 2020? I mean, the current job losses in AI-driven sustenance can pay for grocery bills, but I don't know how one buys a house with it or does anything more than basic stuff with it. So what's your view?
So basically, I'm not in the market of making predictions in general. I will just talk about the way the winds are blowing, what direction, because frankly, any prediction I make is going to be wrong. And if I'm right, I can't take credit for it because it's just random. The reality is poorly. If you look at the current situation, every business, every individual falls on the spectrum between utterly out of work and living off of government assistance to the other end, which are the rare few industries that are flourishing right now. And depending on the industry you're in, you're either largely unaffected or you are massively affected. Now that's the interim. Of course, the economy is nothing but an interconnected web of industries. So therefore you cannot isolate one sector of the economy and assume that nothing and affect everything else and expect that one sector is not going to be impacted. We are all in codependency. So that means in general, at the very least, there is a large chunk coming out of consumer spending for the next little while. Consumer spending being the largest component of GDP basically means definitely we're in a recession. The question is, how long does this last? How many times do we have to go back indoors between now and the discovery of whatever vaccine is going to save us from this thing? But can we rebound relatively quickly from a short period? In general, the economies have been shown to be pretty perseverant. Yes, the longer things go, the worse they get. That's pretty much the general direction or consensus I'll give.
Got it. And what do you think in terms of the impact?
Anything else you want me to add?
No?
Well, I guess if
well,
I
let
could
me
add
just give you the
something,
general thesis
the
on.
economics. Go ahead.
Okay, well, fair enough. So in general, my general thesis on the Canadian housing market in general altogether has been we are just waiting for a disaster. We have fallen into this belief that high to mid single digit, if not double digit returns are the norm for real estate. They most certainly are not. You can look back 15 years and say, oh, look, it grows at 8. You can look back 20 years and see that the number drops to 6. The further back you look, the more the number drops closer to inflation. And what really has basically been, there's been a couple of reasons why this has happened in the, let's call it last 20-ish year period. And, besides the greater degree of urbanization, we've also done this on the backdrop of interest rates dropping from high double digits from the 20s down to where we are today, which is near zero. And that has led to a massive debt-fueled bubble that has basically driven up pricing. Now, again, if you have $1,000 a month to spend and interest rates are at 8, 9, 10%, the amount of money you can borrow is a lot smaller than if interest rates are at 2, 3%. So it's not surprising that asset prices get inflated in a market like that. So now that we are in a period where we are hitting an economic blip, which could be an economic chasm, if it's a blip, I think real estate prices will largely bounce back and be perseverant. If the longer this lasts, that's a different story. I mean, we're in a stage right now where people don't have to pay their mortgages for 6 months because they can apply for relief, right? But that's not going to be extended indefinitely. And even when we do go back to work, the reality is there are going to be lots of businesses that are going to be forever changed, shut down, whatever it is. And that's going to lead to supply side economics having an impact. So where does it go? I don't know, but there's a lot of strong headwinds pushing it in the opposite direction of the current trend.
Got it. Harrison, coming to you, what do you think about the economy and how it's trending, given the whole EI-driven economy? And then follow it up with how do you think that plays out in the context of property prices?
Well, I think Jason touched on some interesting points. Really, time will tell. If it is just a blip, maybe we see a faster recovery. But if this is, settled in for the long haul, we could be in for some rough seas ahead, so to speak. The good news is that the federal government has put in a pretty robust economic stimulus package, which has come in the form of the CERB, EI, payment deferrals, loans, wage subsidies, et cetera. It's definitely helped soften the blow for the time being. It's probably too early to tell if these measures are going to be enough to get things back on track after the sort of initial 6-month period runs out. So, everything that I've been reading, and I'm no financial expert or economic expert, but everything that I've been reading says the forecasts are expected that the economy is going to shrink by 5% this year. In real estate, these things are often tied together, but the outlook is actually quite different for residential versus commercial properties. In residential side, I don't think we're going to see the same kind of issues we will on the commercial side. I don't expect to see a large number of mortgage defaults. Interest rates are going to be low for the next few years, like Jason mentioned, close to zero. The Canadian banking system, strict rules for lending, including the mortgage stress test, make the residential housing market and its debt a bit more protected in some of the areas, like we see in the US, for example. For commercial, it is still too early to see because we haven't really experienced any major, delinquencies, but it appears that there's going to be a much higher risk of defaults and drop in pricing. There's tons of commercial property tenants at the moment that are unable to pay rent, as many businesses are struggling, and some will fail. There's going to be a large number of vacancies coming. Rent values will drop. The demand will far outpace the supply. Banks are also tightening up their lending practices. Commercial properties have been frozen for new loans in some cases, and even refinances. So there's a big risk that they're not going to be able to make their payments. Overall, this could mean troubling times in the short to medium term.
Got it.
So I think if I can add to that, I mean, we can agree to disagree on residential. I mean, we're already starting to see upticks in default rates despite the 6-month deferral period. And at the end of the day, if you come out of this and you're without a job or you have to force and shut down your business, $2,000 a month or EI or whatever wage support subsidy is not going to be enough. And they're not going to defer indefinitely forever. That's just not going to happen. The point on commercial real estate, I would say there's a very interesting market dynamic going on there. I agree with you in general that the number of businesses shutting down to create a supply glut. I think the other two issues, what we see here is there's a number of landlords who are just refusing to take part in the government subsidies because it's just too much of a hassle, believe it or not. I think that they fail to understand there's going to be fewer people on the demand side looking for space once this is all over. And then the last part of that is, let's not forget that every business now is asking themselves why they're paying for so much commercial office space. Because if they can get their businesses effectively running remotely on a work from home trend that we're seeing now out of absolute need, then I've had conversations with several business owner clients who've basically said, yeah, I came in the office to pick something up. I look at all the space and I wonder, why am I paying for it? Everything is working just fine with everybody working from home. So I think we're going to see a trend towards more work from home days and a reduction in just general, first capacity utilization will be the first thing to reduce, and then eventually actual size of rental units altogether. And that's a demand drop altogether.
Yeah, I like the distinction between commercial and residential. Thank you, Harrison, for pointing out, because the different asset classes might not only have different impacts that they are facing from COVID, like Jason, you were saying businesses and commercial spaces would have a tough time, but also the time that they might take to recover or not recover at all might be different. On the residential side, though, my worry is that the two things that have been driving the Toronto real estate prices, given the demand-supply mismatch, one is immigration and two is the job growth. And now both of those are kind of losing the wind in their sails because immigration is on a pause, like literally on a pause. Nobody's going anywhere. And if you were somebody high skilled in another country, this is probably not the best time to move into any other geography for that matter. Not just Canada. So if immigration goes down and it's anyways on a pause for the next several months and jobs are not there for the next several months, then I don't know, will it take like 2 years before it comes back? Because for the next 6 months, we are still on the bottoming side and still fetching and looking for the bottom. So that's my big concern. What do you think, Harrison?
Well, you know, I think it's too early to tell. It might be a common theme for much of the questions here. But, you know, Canada's immigration policy is pretty strong in attracting, you know, qualified people from all over the world. I think we get somewhere in the ballpark of 250 to 300,000 new immigrants a year. And Toronto typically receives about half of those, or plus or minus. You know, the city of Toronto is expected to grow to somewhere between 8 and 10 million people in the next 10 years. So, you know, the lack of supply historically in the city has been one of the driving factors. And that's been, you know, definitely, I guess, hampered by the fact that we get so much immigration into the city. You know, I don't know that we can make any kind of predictions on what those immigration numbers are going to look like until we know people can move about safely.
Right. I mean, that brings another point to mind before we move on to the next question is, it's not just immigration and not just the jobs, but also what about all the international students that we see coming in every year in large numbers? That's not only paused, the entire class of 2020 is graduating in like a really grim job market. They either have no jobs, no internships, or they have jobs that don't necessarily pay the same as previous graduating classes, all impacting negatively, kind of changing all our positive factors into negative. And I'm sure it's not a Canada specific thing, but then for us, that was a big driver of why prices were going up. Okay, moving on.
Yeah, I mean,
yeah,
sorry if I may add there. Well, so the immigration piece, I will say with authority, because I have clients in this space, they're just not even taking applications anymore right now while this is going on. So that is ground to an absolute halt. The other piece of that is, projections on growth in cities are one thing, economics is something else. And if we're already at affordability issues, how we cram another 8 million people in the city seems a bit much to me. And the other thing is too, to remember, and there's already almost a deurbanization trend happening in other major urban centers that have experienced this. You have in the Valley, in San Francisco, you have a lot of major corporations saying enough of this and setting up sites well outside of what was the traditional Silicon Valley now, because affordability has become such an issue for their own people. And deurbanization, the reality is that we look at things from the lens of the way things are. It just takes a couple of technological innovations to shift the entire paradigm to something completely different. I've used the hypothetical of, and this is, again, I spent a lot of time in the tech sector, but the entire thing is like, if Hyperloop actually worked, for those of you who follow that, the ability to go from Detroit to New York would be within 30 minutes becomes possible, right? So then why do you need to live so close to the core of a center? And it sounds kind of ridiculous, but keep in mind that cars took over from horses in 10 years, basically. So I don't know. When I hear those predictions, I always say that's a nice thought. Next 12 months, we can probably forecast relatively well. 10 years out, it's an absolute fiction.
Cool. Moving on to the next question. What is the outlook on property prices in the next coming 3 to 6 months? Would you recommend people wait for a low point? And I think maybe we'll start with you. What would you advise?
Well, 3 to 6 months is not a very, long-term forecast. It's a big question that nobody seems to really know the answer to. There was a recent CIBC report that said the real estate market is expected to drop between 5 and 10% this year by the end of 2020. TD came out with a contrary report that said they're expecting an 8% increase by the end of the year. So, it's kind of all over the place. My feeling is it's probably likely to end up somewhere in between. Toronto typically has a busy selling season for real estate in the springtime. Right now, the pandemic has basically frozen that. The transactions have gone down 65% year over year from last April to this April. There are still some transactions happening, and anecdotally, you see the occasional distressed seller or somebody who's in a situation where they need to sell because they've already purchased something that happened before the pandemic began, and so they're kind of stuck with the property. So you do see a little bit of this happening, but overall, the Toronto Regional Real Estate Board just reported a 0.1% increase in sale prices from this time last year for the same period. So,
but in fairness, they pick their own goalposts. When it's positive year over year, they use, if it's negative month to month, they use year over year. If it's negative year over year, they use month to month. They are notorious for this nonsense. And it is down 10% month to month right now. So to say, oh, well, we're still up despite that. Well, when you get to pick your own goalposts, it's very easy to score a goal.
Yeah, I agree. The Toronto Real Estate Board is notorious for, fluffing the numbers, so to speak. But, it's tough to really take this current period and compare it to anything, because we're seeing stuff that we've never seen before.
Yeah, I mean, talking about Toronto Real Estate Board, even their data suggests that between March 15 and April 15, it was down 50%. Like if you compare to first half of March to later half of March and compare that to April, the transactions are definitely down. I mean, prices maybe not, but it is also possible that some of these transactions were already midway or in conversations and further ahead, and they're just getting reported now. In like you were saying earlier, probably distressed sale sort of a scenario.
Yeah. And I will say this much. There's an old saying that God invented weathermen to basically make financial analysts look good. Prediction is, like I said, I don't bother with it because frankly, who knows? The only thing we can know is where the wind's blowing right now. What's going to happen with prices next 3 to 6 months? It depends on how long and severe this all happens, because all we know for certain is that if people can't work, if people can't work, that's negative on everything. Consumer spending, savings, buying anything, whatever it is, that goes across the board, except for those rare industries that are benefiting from what's going on right now. And what the real test is come 6 months time when people do have to start paying for their mortgages again. That's the litmus test. If we did not have that 6-month deferral right now, those numbers would be atrociously worse right now.
Fair point. At this time, I would like to take a question from the audience. So thank you, Rajiv, for the question. Rajiv is asking, please share more on the condo market in GTA. Will their prices drop? Is now a good time to purchase? Either of you would like to speak on that? Condo prices?
So, you know, nobody has a crystal ball, so it's really hard to make predictions. Mm-hmm. But there is still such a large price gap between condominiums and, you know, traditional single-family homes that anything that's in the entry-level price category is likely not going to suffer. The price categories that are suffering currently, and I think will continue to suffer, are in the luxury market, and then also specifically in the higher price condominiums.
I would agree with that.
Is now a good time to purchase? Sorry, Jason.
No, go ahead.
So is now a good time to purchase? You know, I normally like to tell people that ask me this question that you can't really easily time the market on the way in. The only way to ensure you're not going to lose money on your investment is to time it on the way out. So the best way to do that is to not buy more than you can afford and don't sell at the wrong time.
So the condo market, I completely agree with most of that in general. I'll expand on one point to add, but it's the luxury condo market, the higher end stuff is, first off, those markets are generally highly sensitive in the first place. So, but condo markets being more so. Secondly, the condo market's got an interesting tale in the last couple of years to tell. You know, the number of real estate investors who bought several condos has only increased precipitously, and in part driven by Airbnb, which now we know is in a shambolic state. And someone just popped up about 15,000 Airbnbs. Last number I saw was far, far, far larger than that, probably about 3 times that for Toronto. The reality is that if you look at, there's been several reports published in the last couple of years showing that the average condo investor buying in the GTA, something like 50% of them were net negative cash flow per month. And something like 30% of that 50 were down over $1,000 per month. These were people who were one of two things. They were either getting outsized rental from the short-term market, which in many cases they were, in many cases they weren't, or they were so confident in the capital appreciation that they were willing to take a negative yield per year, which is, and I've seen this, I've actually had to argue with clients who had negative yields saying, what does it matter if it goes up 15% per year? To which I said, stop smoking whatever you're smoking. It's not going to go up 15% per year. So the answer is the condo market is an interesting, different market from the rest of them in that it's had some other, it's been a larger degree of investment purchasing. It's been a large degree of Airbnb speculation. And a lot of that now is going to be very heavily tested because at the end of the day right now, people who bought these things for Airbnb properties, a lot of them are going to think this could happen again. I don't want to do this. Maybe I should find a long-term rental. Or they were in a position where even with a long-term rental, they cannot break even and they don't want to pump money in because maybe they lost their job. Right. So you have a lot of, there's going to be a really weird reckoning happening in that space. So I'm not really sure what that happens. And if it's severe enough, you could see a massive amount of inventory hit the market simultaneously. Now, hard to say. Again, depends on the severity of the entire thing. But I do think in general, the short-term rental market, the appeal of that has largely vanished, knowing that you can go from fully booked to nothing overnight. As for, is it a good time to buy? I would echo the same point of you can't, just don't try to time it. Just don't. The reality is you have to ask yourself, why are you buying in the first place when you get in? And you're buying for one of two reasons. Personal use. If you're buying for personal use, does the math work? If it works, great. And how long are you going to hold it? If it's personal use and you plan on living there 10, 15, 20 years, it's your forever home, whatever it is, go right ahead. Right? I mean, as long as you're in a position where job security is not an issue right now. That's the first piece. If you're looking for it as an investment property, that is a separate question altogether. And that comes down to, again, does the math work? If you are 50% of these buyers who basically are accepting negative yields, that is absolutely foolish. Find me an investment that you're willing to pay. Find me any other investment in this world that people are willing to dish out money on a monthly basis for, as opposed to getting money from it, and take that risk, and you won't find it.
Yeah, I kind of
So the answer is, as always with financial planners, it depends.
I kind of agree with Jason on the last piece, because as Harrison said, they're competing forces. So yes, you might have some people losing the ability to buy a condo because of EI and financial concerns, but then you would have a lot of people downgrading to a condo because now they don't want to take on an expensive, larger mortgage. So net, demand may be comparatively similar to what was in the past, or even more. So it's hard to say. On the supply side, there can be Airbnbs coming in, but there can be people who are planning to upgrade from a condo to a house, not moving out. So again, there are multiple forces. So if you, as long as you're buying for yourself, you have to think of the house more as a consumption good. If you're living in a rental place, paying $3,000, $2,500 a month, then you have to kind of build that into your economics. Is it worth incurring a $30K extra rental expense, or put that $30K extra in a condo that you own and you can build into your own home? So it is more about whether the economics work for you right now, and whether or not you can service the mortgage, that your decision to buy a condo to live in should be. Investment, I personally feel this is not, like, you have to wait for it to go down a little bit more. If you're thinking about investing, if you are expecting people to come rent it or Airbnb it, but like even with Airbnb, I don't see the demand coming back. Hotel industry is probably something for a separate discussion altogether, but I don't see, at least myself, and I'm a big Airbnb user and I've been that for years, but I don't see myself checking into an Airbnb anytime soon. I would any day trust a Marriott or a Hilton right now, who promise that they will keep me safe, have completely thoroughly sanitized the whole place, over an Airbnb with an unknown owner. So I don't know how long that will take to recover. I think Rajiv has clarified this question is regarding living in it and not as an investment. I hope you got.
If you're looking to live in it for 10 to 15 years, go right ahead, as long as the math works. But just again, buy what you can afford. And that is not 50% of after-tax disposable income like so many purchasers in this market. So that's the other metric.
We have another audience question. Thank you, Weber. As a home buyer, what is the homework I can do now, if not start buying residential property now? So if I'm guessing he wants to say if they're planning to buy a residential property, what's the homework that he can do now?
There's several guides online about things to consider when buying a home. I'd say the first thing you have to do is properly educate yourself as to the true cost of home ownership. Most people do the math on what they can afford for a mortgage and stop there. And then they're like, oh my God, this is costing me how much more? Saw it recently with a friend of mine who's bought his first place. The reality is that there's all kinds of friction costs that come with the initial purchase: land transfer tax, closing fees, legal costs, like that stuff. You have to factor that in, because that is not necessarily small. And also, if you're using CMHC, that is not small either. So your purchase price for the $500,000 condo is probably significant, is several thousands of dollars higher than $500,000. That's the first piece. The second piece is also understand that maintaining a property requires a fair amount of investment. There's no definitive study on this, but various figures point to somewhere in the neighborhood of about 1% of the market value of the home just to maintain it per year. And people, even if you're a condo buyer and you're putting in money into condo fees, you know what, that's fine. That takes care of the common elements. Doesn't take care of the fact that you're going to need to renovate that kitchen at some point, or you're going to need to upgrade, that dishwasher, whatever it is. So factor in that you're going to have a cash flow need just to make the thing stay at the value it's at, and know what that looks like. Also property taxes, utilities, all of that. These are things I don't see people stop to consider before they look at it. And then I would say, there's plenty of rent versus buy calculators out there, plenty of free resources on this, plenty of guidebooks to take you through it. Make sure you understand the decision, because it is the single biggest decision of your life. And the vast majority of people won't even pick up a calculator before they actually make that decision.
Harrison, what do you think?
So yeah, I would just add specifically for people that are shopping for condos, there's a few things that you can consider. You know, typically and usually in order of importance, we recommend price is the first thing you factor. So definitely focus on what's affordable for you, and certainly, you know, consider future resale value and marketability of your property. So if it's something that is user friendly, like you know, an efficient space rather than you know, a $1.5 million one bedroom. Just as an example, location is another major one. You know, in real estate, location is the kind of old adage. So, you know, are you close to transit, main subway lines, neighborhoods, you know, a reputation of the builder, the quality of the build, what type of building are you buying into? Is it 80-story high-rise, or is it a boutique 15-story building? You know, those buildings will be run, managed, and wear and tear very differently from each other. Another one is view. It's important to some people. So these are all things you can start to research at home. You can do it by checking out listings and gathering information.
I would also add, don't be very cautious around condo fees, because there's all kinds of shenanigans going on there. So new builds condo fees tend to look very affordable compared to pre-existing construction. But I will tell you, there is no rocket science. There's no witchcraft to this. A building degrades generally at the same level as every other building, and as long as it's well maintained. So I've literally seen cases where condos went up and their condo fees were 1/3 what the building across the street that was 10 years old was. Within 4 years, they were 90% of what that existing building was. So do not, you know, if you buy something with a very affordable condo fee because it's brand new, you better expect that thing to increase substantially. Also, take in existing buildings, take a look at the condo fee history if you can get your hands on that, because there's a lot of really poorly run condo boards out there. Let's not forget, these are volunteers who basically do this within who live there or rent these places out, and some of them have no business making financial decisions, quite honestly, for budgets that size. And I have literally seen cases where, you know, basically to make the building look more attractive, they would not increase the condo fee for several years. They would just special assess everybody when money was needed. And that made it look like the condo fee hadn't gone anywhere, was very well controlled. But in actuality, the assessments were enormous. If you're not seeing condo fee increases of at least inflation per year, the people running this don't understand how to actually do proper budgeting. And if you're seeing substantially greater ones, they're probably making up for something that's gone horribly wrong.
Yeah, I think those are some really good points, both from Harrison and Jason. I would just reiterate, you have to do the economics. Like, what is the unit economics for whatever you're buying, and not for 1 year, but you have to at least do the math for the next 5 to 7 years, because you will lose money if you're selling in like 2 years' time. The only way that you would be selling your house and moving to upgrading to a bigger house or a new locality or something, you have to factor in at least 5 to 7 year time horizon, and then factor in all of these things to see, does it have appreciation potential? Do I see the condo fees potentially going up? Do I see the condo having upgrades in this time? There are some really fancy condos that have an insurance problem because of flooding, and their insurance is not getting renewed. Things like that, yeah, waterfront condos are awesome, but I know of some really awesome condos who have some of those problems. So look at what can happen over the next 5 to 7 years. And of course, in the current environment, the last thing you want is to not have a buffer. So whatever is the budget or math that you've done, make sure that you can survive in an EI kind of an environment for at least 6 months. That's at least my personal thumb rule, that I should have a buffer of 6 months of survival with no job, no external support, pay my mortgage. Lots of good tips from Jason and Harrison. Thank you guys for that. Moving on to the next topic, and we also actually have a question from somebody. Huge levels of Canadian household debt, leaving many without financial resiliency. My question is, what is your take on the mortgage interest rates and how this might impact the market demand? Mortgage rates are already down. I would assume they might go down further because they were much lower in the past. So how would that play in? And is that something that should be considered an opportunity for people? Harrison, you want to kick that off?
Sure. You know, generally speaking, mortgage rates being low encourages buying activity so that it can have a direct impact on real estate. But it can also encourage growth in the economy, which can translate indirectly into real estate activity. You know, the problem is right now, even though interest rates are low, until people have money to spend, you know, things aren't going to continue going positive.
Yeah, I mean, again, people tend to overly focus on the mortgage because it is, I mean, it's typically the biggest part of it. The reality is that the difference between 3% and 2.75%, like the reality is that we're in a stage of what is known as the inelastic side of the demand curve, where the small changes do not have the impact that coming down from 7 to 3 did. Yeah, so lower helps, the market helps basically spur demand, but if people start losing their jobs en masse, it's not going to matter.
Right. Okay. I mean, in my opinion, mortgage rates would go down, and like going down is great if you are a home buyer. But then I don't know what the risk appetite of the banks are going to be, because if they see mortgage defaults and in any quantity, their risk appetite might be down. They might be more cautious and be more particular about stress testing, because they know the environment is not as rosy as it used to be. Okay, I think we have a bunch of questions piling up as well, in addition to the chat. If you guys open the Q&A tab, you will see a bunch. So the first one is, the crisis versus 2008, what are the differences and similarities from the perspective of impact on residential housing market?
So let me take that start. So 2008 was a completely different beast. 2008 was a questioning if the entire financial system was going to just implode altogether. And, it was really hard to understand that the entire basis for how our economy transacts money was actually technically called into question and stress test. This is a public health crisis. There's a difference. Also, I would say that the 2008 crisis is what's called comparing ourselves to the US and playing a tale of two countries. The US was far more exposed to adverse things that it had done to itself in 2008 than Canada was. And that's largely why we survived. Also fueled off the back of the fact that we happened to, when there's a crisis and everybody wants to spend on infrastructure, and we sell all the stuff you need for infrastructure, like materials and oil, hey, our economy did pretty good for that period of time. So we were in a fortunate position, as evidenced by the growth in Alberta altogether. This time around, there is a significant difference. The US is in a far better financial footing than we are. If you look at the metrics for Canada versus the US, and just about every metric that matters, comparing us to the US in 2008, we are well beyond their levels. When it comes down to household debt, we are well beyond their levels in 2008 versus where they are now. The carrying cost of homes as a percentage of disposable income significantly higher. The economy's dependency on the real estate sector alone is just enormous. And those numbers are all almost orders of magnitude above where the US was. So quite frankly, if we hit a prolonged period of time we're in a recession, yes, the housing market will suffer, but the housing market was more important to economic growth in Canada than it was in the US pre-2008, which means that the post-COVID crisis will be even worse for Canada than it will be for other places in the world.
Harrison?
Really, I would just echo the fact that, the longer it takes for the economy overall to recover, it will affect directly, the housing market. So, after 2008, it was 2.5, 3 years maybe before we were back to normal. And then, back on the up and up. I don't know that we're going to be better or worse this time around. It might be too early to tell.
Yeah, that brings me to another question. Given that 2008 was more banks, subprime driven, kind of like a financial institution mishandling sort of a setup versus an external pandemic driven shock. Do we expect fundamental shifts in the industry in terms of process, behavior, and even economics? We touched a little on this, commercial versus residential, but overall, do we see fundamental shifts happening?
Well, already it's happened, and it's largely because of policy and social distancing and lockdown guidelines. So basically, everything in the industry has gone online now. And this is the case for most businesses, I would imagine, if they're able to. So in real estate, that includes everything from virtual open houses, digital contracts, electronic signatures, virtual staging using renderings, even appraisals from the banks, virtual consultations for home improvements. Even lawyers are processing sales using programs like DocuSign, VeriSign, AuthentiSign. So the pandemic has really identified a lot of places in the industry that can be run more efficient using technology.
Yeah, and yeah, that's true. Sorry, Jason, go ahead.
Yeah, I mean, there will be I think the reality is we lived in the pre-COVID world, we're living in the interregnum COVID world right now, and we're going to live in the post-COVID world. And a lot of things will change even if we did find a immunization for it tomorrow and all got vaccinated within a month. This is shell shocking a lot of things, right? There are some of it good, some of it bad. So as we discussed already, there's going to be a push towards more work from home, I think, in general amongst businesses. There's actually a meme going around right now that says your business went virtual because of forward thinking, adoption of technology, blah, 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 COVID, check mark, right? Like the reality is that we're all being forced into a different paradigm right now. And a lot of this paradigm is going to stick. And the longer we're in this paradigm, the longer that those effects are going to stick. And let's not forget that even with things rolling back, there are certain sectors of the economy, certain businesses that are not going to be able to operate like normal for a very long time. I have a friend who's a hairstylist. That sort of business is going to be very difficult with social distancing. Flying, so very difficult with social distancing. So a lot of 2008 other crises did not involve behavior change to the extent that it does now, and that's going to have a negative impact because a lot of those models are not going to be as profitable anymore. Airlines made money by squeezing us into the smallest space as possible. Not really an option anymore.
Yeah, talking about those virtual tours, there's a question saying virtual tours are gaining traction these days because of travel restriction, and that's quite true. Like we, even at BuyProperly, when we are renting out, we are using virtual tours. The question is, are there any pitfalls of taking a purchase decision basis of virtual home tour? What do you guys think?
Well, it's a risk. Yeah, it's a risk. I mean, it's like buying a pre-construction condominium. Like you don't even get a virtual tour. You're just buying a piece of paper. So there's inherently risk whenever you buy real estate. But I think because Toronto has been a very active market certainly for investment in pre-construction projects, I think a lot of people are used to the idea that they're buying something off of plan or off of virtual reality or without ever actually stepping foot into the property. I've seen some deals recently happen as early as last week where because properties are currently occupied, people wanted to find a way to list and sell in this COVID environment. So what they would do is they would make the offer conditional on an actual visit to the property. So in other words, you reach agreement between buyer and seller on a price and terms, and the offer is then conditional upon the new purchaser going and actually seeing the place for the first time after it's been purchased. So there's a lot of different shifts in that regard. And I think people are generally adapting well.
Yeah, I mean, there's no choice. We have to do it this way, and people are getting used to doing everything virtually, right? I'd say that when buying a house, when buying anything, especially if something you can't undo that big, there's a different degree of risk there. I mean, the thing about virtual tours is they can be curated as to not show you the ugly side of something, right? But then again, if you look at the Toronto real estate market, frankly, I can't understand why you would ever buy a house or property without a proper inspection done. But in a competitive hot market, you forego these things and take on these risks. So I think given the one thing I will say is that given the drop off in what the demand side looks like right now, but if the demand side drops off, I think you are going to see even with virtual tours, you're going to see more requirements for conditions on having to go there in person for person inspection and professional inspection as well.
Yeah, I mean, those are some good points, and there's actually corresponding question to that is talking about structural shifts. So there was a question where somebody asked, will this crisis bring about a change in way the real estate commissions are paid? Because the buyers are paying 2 commissions, and there's almost a conflict of interest.
I'll go quickly on this. Countless countries, countless places, countless fintechs, countless whatever have tried to say this system's ridiculous. 5 points in Canada, 6 points in the US on such a large purchase. This person put it on MLS, put up a sign and prayed, which is the 3 Ps of real estate, and really did very little for it. I gotta try to do this. And to date, the vast majority have failed miserably and run out of town. There is just, maybe it's because you do it so rarely. Maybe it's because of asymmetric information. God knows what it is. There's been downward pressure from the general world on the pricing of real estate for a long time. We've seen some of that happen and impact and people being able to negotiate slightly lower, but I'm not overly confident that something in this paradigm, something about what happened now is paradigm changing enough to alter the real estate compensation landscape.
And maybe I'm definitely a little biased when it comes to this topic, but I would say that you tend to get what you pay for. So if you're discounting rates, a lot of the time when you see agencies or brokerages slashing and discounting, undercutting, so to speak, it's at a severely reduced service as well. So you have to be careful about that.
Yeah, I kind of agree with Harrison on that one. Although personally, I'm a believer that I wish I had no commissions to pay for. I do realize that it's a service that the commission is paid for, and probably in a high tide, all boats go up, so all agents get that 5% commission. In a low tide scenario, you will quickly see people differentiating, people who are actually doing their jobs well and working hard and making sure that you do math, negotiating on your behalf, will probably not be cutting down on the prices. But then people who were anyways not doing as much effort are the agents who would be the first ones to cut the prices to make sure they get their clientele. Because a lot of agents get it through referrals, and if they have done good service, they will continue to get referrals. So it's kind of, it's a service industry. So I would expect a lot of agents who were not, who were just out there for a quick buck might be cutting commissions for sure. But then if people are cutting commissions left, right, center, then you have to also be mindful of, like Harrison said, you get what you pay for. Also mindful why they are cutting commissions. There's a bunch of questions around the stock market, and maybe we could take some of them. We are running out of time.
Just typing one of them, so go right ahead.
Oh, okay. Okay. Yeah, but then before we get into the last one on the real estate property prices one, there's one question which says, do you have any thoughts on real estate demand and prices in smaller communities outside of Toronto, Muskoka, Sound, etc.? Do you think more people will be leaving the city center, GTA? And of course, there is a corresponding question where as people become more and more remote, they would basically realize that they can actually essentially work from anywhere. So kind of move to smaller cities rather than the city center. So what do you guys think?
Well, Jason sort of touched on this earlier when he was talking about how, the Silicon Valleys of the world have shifted, and now they're going into non-traditional areas that are not dense urban centers. So I think it'll be interesting to see how, the mentality of people changes and how habits change. Certainly specifically for markets that are traditionally outside the GTA, or maybe even considered secondary home markets or vacation properties. These are markets that tend to be much more sensitive when there's economic crisis. So I don't expect that there will be a higher appetite. I think will be the opposite.
Got it. Okay, coming
If I may on that, I'd say that the other thing to remember is that secondary personal use properties tend to be the ones that get sold first. So if you get into financial difficulty, you typically do not sell the primary residence first, you sell the cottage. Florida is the perfect example of that. They've been through countless boom bust cycles because they're America's cottage country, more or less, right? So I think in general, the cores tend to hold better than the periphery. However, again, different things are happening that are deurbanizing, so it's hard to say. But specifically, like that type of area, like Muskoka, where it's largely recreational, certain lakes, certain other thing is a lot of those are very high value prices. We've already discussed how those suffer, top end of the market's going to suffer more. So I think it's not going to be the most strong wind at their back going forward.
Right. I know you were typing the answer, Jason, to David's question. For the sake of our audience, I might just take that one as the last question. Why is the stock market not reflecting the dire circumstances today? We are not far from historic highs in Jan still, and with the implosion of oil and poor footing of Canadians based on debt levels, will the Canadian dollar fall further?
Okay, it's a bunch of questions. So the first one in general about the stock market not reflecting dire outlooks. As I see it, there's three opposing factors. The traditional one right now, in general, let me some more light here. It got really dark in here. The traditional one in general is that right now, stock markets should always reflect what are the generalized expected earnings of all corporations on that market in the future in kind of a group sourced sort of way. So based on what's happened and earnings expectations dropping for so many companies, there should be massive pressure that pushes us well below where we are today. That's the normal conventional thinking, and I believe that. I think that there's two opposing factors of that right now. One, there's a disproportionate amount of, I shouldn't say that, there's right now there's a larger degree of concentration in a lot of giant tech companies on these indexes, right? So if you look at the FANG plus Microsoft represent 50% of almost 50% of the NASDAQ. They represent something like 25 to 30% of the S&P, and in Canada, even Shopify is now bigger by market cap than RBC. And those type of companies have actually done incredibly well through this entire crisis, and they're going to continue to do it. They're continuing to benefit and potentially forward into the future because of higher user adoption rates. So you have the largest chunk of the indexes doing well, while the rest of it, the larger percentage, is doing poorly, right? So there's a bit of a countering force right there. And then the last part of this is that as long as governments around the world are willing to turn the tap on and coordinate efforts in perpetuity, as they said they're going to, it is impossible to tell how this ends, right? Like, that's the reality. If they're willing to throw money and bail everybody out and do everything they possibly can to stimulate us back to where we were before, it's anyone's guess where this ends. And as for the currency, good question. Canada's currency is highly, highly correlated with the price of oil. That is very well known history. And we all know what's happened with the price of oil in the last couple of years. So, in the last couple of months, sorry. And so it's no surprise to me that the price of the Canadian dollar has substantially taken a hit. Where does that go from there? Who knows? I do think that the general demand for oil is going to be larger simply as people start driving more and planes start flying more and cruise ships eventually take sail. Just by nature, there's going to be more demand for the consumption of it, so that will help us. But it's currency bets are the hardest bets to make.
There's one question which I kind of think applies to BuyProperly quite a bit, and I want to know your thoughts. Is it a good time to invest in REITs or fractional real estate in this scenario?
Ursula, you go first.
Yeah, so I mean, REITs are a tricky one. I mean, a lot of commercial REITs right now are really struggling, and I think they're going to struggle a lot in the future. You know, there are some, I guess, tenants you would consider to be recession or pandemic proof. So if you're going to be looking at those types of asset classes, look for properties that usually have tenants that are like grocery, pharmacy, liquor store, but really nothing is guaranteed. So REITs, I would think, are a little bit riskier proposition than usual right now, and certainly for the near-term future. But fractional ownership in general, I think, is a way for people to get into a market without taking a lot of added risk. So you share your your down payment with a pool of people, and you share the risk in that regard. Also, you know, if the property is managed well, it's kind of a turnkey investment for you.
I am definitely biased on this one because we are a fractional
No
real estate
kidding.
investing company.
No kidding.
So of course I'm biased.
And here's what I'll always say to the investment question. Do not make sector bets. You're making a one-sided bet on one general part of the economy. The simple principle of diversification, end of story. And you know what? The reality is that it's not sexy. It doesn't blow the lights out. You don't brag about doubling your money overnight, but you never implode. Right? We literally have clients in, you know, conservative balanced portfolios who are looking at break even to slightly down right now, and a couple and even some more conservative ones that are up. And they are just staggered by the fact that they're not part of this bloodbath, right? And if you take all your money and bet on one sector of the economy, and the roulette wheel does not come up on your number, the money gets pushed off the table. So do not take a single bet, take a lot of them in different sectors.
Yeah, I would echo Jason's thing. Whether you invest through fractional real estate, whether you invest directly into real estate, it's important to make sure you have a good balance of equity, fixed income, cash, all of those asset classes, including alternate assets. They all have different liquidities, they have different correlations. REITs, however, personally, I consider them very akin to a stock market, especially the listed REITs, because they move quite a lot in tandem. In fact, when we ran an analysis, the correlation for the stock market versus the REITs was as high as 0.7, 0.8. versus private residential, because it's not liquid and not traded on the stock exchange, much lower. So I would put
and Kush, we've argued about this before.
Yes.
Lack of price discovery is not stability. It is not. If anything, REITs reflect a more realistic value of all real estate because they trade daily. Saying that something, oh, look, I priced it or had it assessed every quarter or every month, that is not a true reflection of true market price. What you can sell something right now is the only price that matters.
But then it also adds volatility. So every time something mild happens, it changes. Whereas in real estate, that is not how it, just because it's not as liquid.
Lack of price discovery is not a lack of volatility. It is lack of transparency on volatility.
It's more liquidity premium that you're paying when you're paying for the REITs versus
that is true. There is a liquidity premium.
Discovery necessarily. So I think it's the liquidity factor that changes things. But we can agree to disagree given that we are out of time.
That will add a premium on return, but it does not affect volatility. Volatility is just not transparent. End of story. You want to value it every day based on market conditions, then you have transparency. Okay.
Thank you very much. That was, I like that we all have slightly different views on this one. Thank you, Harrison, and thank you, Jason, for joining the webinar. I see we still have a lot of questions. So to our audience, if you have more questions, feel free to email us. Hopefully we will pass it on to the panelists. Remember, this is not a financial advice that we are providing. This is just a friendly debate and discussion. So take it as an opinion and consult your financial advisor before you make any investment. Thank you, everyone. Just pass on the questions if you have any.
There's my bias right there. Okay.
Thank you, Jason.
Thanks, Fishbowl.
Thanks, Harrison. Bye.
Thank you.
My pleasure. Thanks for having us.
Thank you.